Okay, so last week you had your first test, okay, and so the second test will be after we finish. I mean, you can check your WhatsApp for the coverage for topic for test number 2. Okay, another 10% for the remaining microeconomics syllabus. Yeah, and then the most of the marks will be awarded for the test 3 and test 4, okay, which covers for the macroeconomics sections. Okay, so either way, okay, every mark counted, okay, for your overall grading later on. So if you so there's still plenty of room for improvement. Okay, if you feel that you did not do, if you feel that you did not do well, okay, from your first test, okay, there's still plenty of time to recover for the remaining tests and one more quiz and also the group assignment. Okay, so for today, we're going to start on the new topic, number 6, on the cost of production. So the previous topic, number 5, we learned on the utility, okay, which focuses on the consumer side, okay, whereby we discuss on how consumer decide, okay, the optimum or the best combination of goods and services, okay, based on the simple model of the utility function. Okay, for topic number 6 onwards, topic 6, topic 7, topic 8, okay, the remaining on the microeconomic syllabus will be dealing with from the supplier side of the story. Okay, so we finish on the consumer on topic 5. So topic 6 onwards, before we start on the macroeconomic topics, okay, we will focus on the supplier side. So on topic 6, we discuss briefly on the cost of production, okay, fixed costs, variable costs, and also the difference between short run and long run, and also the definition of economies of scale. Okay, again, so what you saw from from the test 1, okay, so you know that from the slides or the lecture notes alone is not enough, okay, in terms of being for you to be able to answer those questions correctly. Okay, you need to do a bit of practice, check past year's questions from the library website, okay, and do as many multiple choice questions as possible for you to get used to the type of questions that can be asked, okay, on the remaining topics for your test. Okay, so for chapter number 6, okay, the main focus of the syllabus is basically on these 4 items here. Okay, what is production function? What is marginal product? Okay, how are they related between marginal product and production function? And also on the cost of production, the different type of cost, fixed cost, variable cost, total cost, and also the difference between these costs, okay, the fixed cost, variable cost in the short run period and also in the long run period. Okay, in economy, we divide the two usually we can divide it in 2 time scale, short run and also long run. Okay, of course, if you study further, it can also be divided into 3, short, medium, and long run. Okay, short term, medium term, and also long term. Okay, but at this stage, we only divide the time frame into 2, short run period versus long run period. Okay, so short run is usually a period of less than 1 year. Long run period is usually more than 1 year and above. It depends on the definition of short run and long run. Okay, but at this stage, okay, we do not define how many years or how many months, short run or long run. Okay, as long as the term short run is used, okay, so you need to know what is the what are the characteristics, okay, to define short run versus long run, and finally, what are economies of scale in terms of the definition. Okay, how do companies or supplier or firms achieve economy of scale? Okay, so we start with the first slide first. Okay, on the cost function. Okay, total revenue, total cost, profit. Okay, so in general, of course, any company or any firm, the main objective is to maximize profit. And the way to calculate profit is simply by the difference between revenue and cost. Okay, so revenue is obtained from the sales of the product. Okay, usually we denote the revenue from the in terms of price multiplied by quantity. Okay, so if the firm sell 1,000 units at $20 or RM20 ringgit per unit. Okay, if they sold 1,000 units, so the revenue will be 20,000. Okay, so P times Q is to obtain the total revenue. Okay, of course, at this stage, in principle of economics, usually you are not needed to obtain the value of total revenue. Okay, unless using a simple table. So TR minus TC, okay, total revenue minus total cost. Okay, so in economy we divide the total cost into two components: explicit cost and also implicit cost. Explicit is something that usually that you can count on, that you include in your balance sheet. Okay, the cost of your labor, the cost of the loan you pay to the bank. Okay, the cost of rental, how much rent you need to pay to the landlord. Okay, so all those direct costs in production. Okay, implicit cost is something that usually only economists include. Okay, implicit, which is not directly appear on the balance sheet or the accounting in your ledger book. Okay, so usually we include implicit cost in economy is termed as the opportunity cost. So we learned the concept of opportunity cost before in the earlier chapter. Okay, the next best alternative. Okay, so if you do something, so the opportunity cost is the second option that you need to let go. Okay, so if you attend the class, if you do your, I mean, let's say this semester or this in the next 3 years or so, okay, you invest your time, your money to get this the degree, okay, from UUM. So your opportunity cost could be the income that you could have earned, okay, if you don't do your degree now, but instead you start working, okay, part-time or full-time. So the money that you can earn by working, okay, could be the opportunity cost of doing a full-time degree course in UUM. Okay, so in economy, we don't only take into account explicit, but also implicit cost. Usually we measure by the opportunity cost. Yeah, of course, this value you need to know which one that you are comparing against, how you define your opportunity cost. Okay, but explicit is very simple and straightforward. Okay, the cost of labor, the cost of your loan, okay, and those things that you pay in terms of ringgit or dollar. Okay, so that is in terms of cost. Then in terms of profit, okay, the term TR minus TC, total revenue minus total cost. Okay, the total cost in accounting is just the explicit cost. Okay, but in economic, whenever we define economic profit, not only we include the explicit cost, but also revenue minus explicit and also implicit cost. Okay, so accounting profit ignores implicit. So usually the accounting profit will be higher than economic profit because economic profit takes into account implicit cost. Of course, in the real world, okay, when you do your balance sheet, okay, for companies that have balance sheet, okay, they need to report their profit and loss account, okay, every year. So usually the implicit cost is not included, okay, because that is not, so in terms of the definition for accounting, they only calculate explicit cost. So of course, this is just in terms of the concept and definition, okay. And then we look at production function. Okay, so in the beginning of the second slide, okay, so we ask the question, what is a production function and how is this concept relates to marginal product? Okay, so in chapter 5, you will learn about utility, okay, and the concept of marginal utility. Okay, if you recall from last week lecture, marginal utility is the additional utility or satisfaction each consumer gets when consuming additional unit of the product or services. Okay, so let's say you break your fast, okay, today. Okay, you take the first glass of water, okay, and then you can assume what will be the utility that you get from the first glass of water that you drink. Okay, but then the second glass of water may not be as high in terms of the utility compared to the first one, because the first one is when you feel very thirsty. So of course that will give you the highest amount of utility, okay, compared to the second glass, the third glass that you drink. Okay, so that is the concept of marginal utility, because we look from the perspective of consumer. But when it comes to producer or supplier, the term marginal utility, the term utility we convert into product. So instead of marginal utility, now we call marginal product. Okay. So because for producer, what is important is the production of goods. Okay, how much producer can produce given the labors, the input that they use in the production. So that is the focus here in chapter number 6. Okay. So production function basically is just showing the relationship between quantity of input and the output. Okay. How much input used and how much output can be obtained or produced from the combination of input. Okay, so for example here, in the next slide, okay, the production function, okay, so we assume only one input, which is labor. Okay, so this is obviously a labor-intensive industry or sector. Okay, only the company or the firm only uses labor. Okay, no machines whatsoever. So number of labors, okay, is the input, and Q will be the output. Okay, so this will be the total production. So you plot as you increase the number of labor, total product will also increase. Okay, so this is total production or total product. As you can see, TP keeps on rising. Okay, but when you apply the concept of marginal product, okay, similar to marginal utility. Okay, in the previous topic, the additional utility obtained when you consume more output. Okay, so the same thing here, marginal product is the additional increase in output when you add one more input. Okay, so here in the previous example, the input would be labor. So by hiring the second labor, by employing the third labor, what will be the increase in the output? Okay, so the marginal output will be the change between increasing from one labor to the second labor. So you can see the difference between each of these would be counted as the marginal product. Okay, so the simple formula will be if you only focuses on the labor, so MP, we call it MPL, marginal product of labor. Okay, because we focus on the labor only. So the value will be counted as change in output divided by change in the labor. So in the previous slide just now, you can see that MPL will be, okay, the change in output divided by the change in labor, because labor changes by 1 unit at a time. So MPL or marginal product will just be equal to the changes in the output, okay? Because the increment in labor is every time by 1 unit. But the main formula would be change in Q divided by change in L. Okay? If I were to change this value, okay, not 1, 2, 3, let's say 1, and this becomes, let's say 3. Okay, this becomes 5, okay, this becomes 7, and this becomes 9, for example. Okay, so what would be the MPL? So this one should be correct. So 1000 minus 0, 1000, divide by 1 minus 0, you get 1000. But for the second MPL, it is no longer 800, because 1008 minus 1000, you get 800. But 3 minus 1, instead of 1, we get 2, okay, assuming that I change the number. So 800 divided by 2, you should get 400. Okay, so the main thing is the main formula, which is change in output divided by change in labor. Okay, so if the labor changes by 2 units at a time, 1, 3, 5, meaning you increase 2 labor at a time. So M marginal product will be change in output divided by the change in the labor. So 800 divided by 3 minus 1, 2, it should be 400. Okay, of course, this is not the original example. Okay, but I just want to show you how MPL can change if you change the value of the labor here. Okay, so that is how you calculate MPL. Okay, and then here is the original number. Okay, so MPL will be the change in the output given the change in input, which is labor. Okay, so this line is the total production. Okay, the changes here that you see, the triangle will represent the MPL. Okay, so and you can see that similar to the concept of utility, if you recall from the previous chapter, okay, you learned the concept of diminishing marginal utility. In fact, last Thursday we discussed, I think, one partial question on the concept of diminishing marginal utility. Okay, why is it diminishing or decreasing? As you consume more and more and more of the same product, the additional utility or the marginal utility that you get getting lower and lower or decreasing. Okay, so again, use your own logical explanation. Okay, my example just now, if you drink the first glass of water, okay, you can calculate your utility, your marginal utility. And then you drink the second glass of water, okay, the additional utility that you get from consuming the second glass will be lower than the first time. And when you consume the third glass of water, the additional utility by consuming the third glass will also be lower than the previous one. So utility will keep on, marginal utility will keep on declining. So that is the law of diminishing marginal utility from the consumer perspective. Okay? But from the supplier side, you can also use the same concept, but we don't call it diminishing marginal utility, we call it diminishing marginal return. Okay? Utility is replaced by the word return. Okay, or here you can see why MPL diminishes, marginal product of labor diminishes or decreasing. Okay, which you can see directly from here. Okay, MPL starts from 1000, then keeps on declining. Okay, so there are several general reasons that you can use to explain why MPL decline or why marginal product decreases. Okay, so because okay, here marginal product of input declines as the quantity of input increase. Okay, marginal product input decline as quantity of input increase. So input here is the labor. So when we increase the labor, we increase the input, marginal products decline. So one of the simplest way to explain this, why MPL declines, okay, is if you imagine if you work in one shop, okay, so if you, or in one piece of land, the more people that you hire, that you employ, okay, if the company employ more and more employees or workers working at the same area, okay, so maybe because the space is very limited, okay, they need to share spaces, they need to share space, they need to share equipment, okay, so or working environment become less conducive, become less comfortable. So by by increasing the number of labor, okay, in the same area of work, okay, let's say in one piece of land or in one shop, when you keep on hiring more and more workers, actually in economy, you need to know when you need to stop hiring workers. Because if your marginal product keeps on declining and declining, okay, that is one of the easiest way to explain why MPL decline. Okay, so MPL declines, this is just the direct definition. Input declines, marginal product of input, meaning here marginal product of labor, declines as input increases, which is the labor. Okay, so MPL declines as you increase the amount of labor. So at this stage, for principle of economics, what you need to know is the definition of the MPL and why does it occur. Okay, and when does MPL actually, in this example, MPL start to decline after the company increase to second labor, meaning when they hire the second workers, MPL now start to decline. Because from 1000 straight to 800, meaning it drops immediately after they employ the second workers. Okay, so the third worker also keep on declining. So MPL start to decline after the beginning from the second worker onwards. So meaning from second employee until the fifth employee, MPL start to decline from second labor onwards. Okay, so that is in terms of marginal product. Okay, we can also look in terms of cost. Okay, so in terms of cost, okay, let me jump to the slide first. Okay, so before we go back to the previous slide, okay, so in economy, as what we mentioned earlier, okay, in the second slide, okay, we want to know the type of cost, okay, and also the difference between short run and long run period. Okay, so there are two types of so just now in general, in economy we consider explicit and also implicit cost. Okay, but what we are discussing for most part of the syllabus will be on the explicit cost. Okay, cost that you can count directly, okay, in your balance sheet. Okay, so if I go to this slide first, so I'm sure you've heard of this concept before. So in terms of total cost, okay, so this is again explicit cost, okay, or direct cost. Okay, so total cost is defined as the sum of fixed plus variable costs. Okay, so fixed cost that does not vary with the quantity of output. Okay, that's why it is termed fixed. Okay, if you produce 0, if you produce 100, if you produce 1,000, the cost remain the same. Okay, for example, the rental, okay, sewaan, kadar sewa bangunan, the rental for the building, or the loan repayment, the monthly loan that you pay to the bank. So let's say you make a loan of ringgit from a bank. So whether you make business or not, you still need to pay the monthly installment in the same amount, okay, to the bank. So that is a fixed cost. So the cost remains the same regardless of the quantity of output. Whether you produce 1, you produce 0, you produce a lot, okay, the cost remain the same. But for variable cost, the term variable means the cost can vary. Okay, it changes with the quantity of output. The more you produce, the more cost you need to pay, or variable cost you need to pay. So the direct variable cost, or in terms of the definition, usually we refer variable cost to employee wages. Okay, upah, kadar upah pekerja. Okay, the employee wages. So the more workers, the more quantity that you want to produce means that you need to pay, you need to hire more workers, or you need to increase the number of hours. Okay, the working hours. Let's say if you work in a factory, if you want the workers to produce more, you need to pay maybe extra time, okay, or overtime for the workers to stay longer in the factory. So wages is an example of variable cost. The more the firm produce, the more wages the firm needs to pay. Okay, so total cost is the sum of FC plus BC. Okay, so in this slide here, okay, of course we don't define yet what is fixed cost, what is variable cost. Okay, but you can see here the cost of land here, which is in terms of the rental, sewaan. Okay, this can also be termed as the fixed cost. Okay, you can put in your slide, okay, if you want to add or you want to edit. Okay, so this can be termed as fixed cost. This will be the term as the variable cost. Okay, so this will be the TC, or total cost, because you can see that the cost of land remains the same, okay, 1,000, but the cost of labor increases as you increase the output from 0. You can see that when output is 0, labor also 0, because you don't pay the workers if they don't work. Okay, you only pay them when they go to work and they start producing output. Okay, but for fixed cost, even though output is 0, you still need to pay the rental. So for example, you close the shop for 1 week or for 1 month. Okay, you close the factory for a certain time. Okay, you don't pay the workers money. Okay, assuming that the workers are paid based on the number of hours or on daily basis. Okay, but for rental, Okay, the cost, your fixed cost, you need to pay also the cost for the rental of the building, okay, or loan to the bank. So even though output is zero, fixed cost is still positive. Okay, so fixed cost, but it remains the same regardless the quantity of output produced. Okay, so variable cost, you can see, increases as you increase the output. So total cost is just the sum between FC plus BC. Okay, and when you plot the total cost, usually you get an upward sloping line lah, because the total cost keep on rising and rising as you increase the number of output. Okay, so previously you learned the simple concept of marginal product. Okay, marginal product or MPL. Usually we refer to marginal product in general. Okay, so marginal product means the change in output divided by the change in input. Okay, we use the term labor because our input is labor here. Okay, so we also look at how you calculate MPL, change in Q divided by change in L. Okay, so that is in terms of output. Okay, we can also, another concept in chapter 6 beside MPL is the term marginal cost. Okay, because you learned the concept of cost just now, fixed cost and variable cost. So, and also total cost. Total cost is the sum of VC plus FC. Okay, variable plus fixed, you get total cost. So marginal cost, the term marginal is the same. Marginal utility, marginal product, marginal cost. So the word marginal is referring to additional or changes in the cost. Okay, so how do you calculate the change in the cost? And which cost are you referring to? It will be the cost, the change in total cost. Okay, not fixed cost, not variable cost, but change in total cost, meaning the sum of fixed plus variable cost. Okay, so the change in total cost divided by the change in output. Okay, so then you can calculate what is the changes in the cost or the marginal cost. So you can see by increasing the output, how much cost, how much additional cost is that the company need to pay, okay, in order to produce one more unit of output. That is marginal cost definition. Okay, the additional amount of cost when you increase one unit of output. Okay, so here the simple example here, you have the total cost column. So marginal cost, again, the formula would be change in TC divided by change in output. So 3,000 minus 1,000, you get 2,000. Output is 1,000 minus 0, you get 1,000. So 2,000 divided by 1,000, you get $2. Okay, and the next one, so here we can see that total cost remains the same, meaning, the change in total cost is constant at 2,000, 3, 5, 7, 9. So, but the change in output changes. Okay, for example, here the change is 800. Okay, between these two, the change becomes 600. So according to the formula, MC calculated as change in TC divided by change in Q. So 2,000 divided by 800, you get 2.5. Okay, and the rest follows. So you can see that marginal cost, first it increase. First you start at $2, then it start to increase directly. Okay, from 2 to 2.5, and then 3, 5, and 10. Okay, so when you plot it here, you get an upward sloping curve. Okay, so usually in economy, okay, whenever you plot marginal cost, okay, of course this is just one example, but later on in the next few topics, okay, in the next 2 or 3 topics in microeconomic syllabus, okay, you will also look at the marginal cost curve. Okay, it start to decline and then it goes up again, meaning there is a point where the marginal cost becomes minimum first, meaning it will go down first and then it starts to go up. Okay, so it does not necessarily, it must be continuously upward sloping. So usually whenever you draw a marginal, or whenever you calculate marginal cost, it is very common that usually marginal cost will decline, okay, and then reach its minimum point, then it will start to go up. Okay, so there will be a minimum point, or the point where marginal cost will decline and then go up again as you increase the amount of output. But in this example, you do not see that, because after $2, then it goes straight from $2, then go to 2.5, and onwards it continue to increase. Okay, but in the next few topics or chapters, you will also see that marginal cost will decline first and then go up again. Okay, so we discussed this slide just now. In economy, we divide the explicit cost, okay, into two: fixed plus marginal. Fixed plus variable cost. Okay, so and then in this next example here, okay, also another breakdown. So you can see the breakdown of the three type of cost: fixed, variable, and total cost. Okay, so you can see that fixed cost is a straight horizontal line. Of course, because the value is fixed. Okay, variable cost is this orange line. So you can logically fixed total cost will be higher than variable cost because TC is the sum of FC plus BC. Okay, so and you can see that variable cost start from zero. Okay, because you don't pay wages, or you variable cost start from zero because when output is zero, variable cost also or wages also is zero. Okay, but when output is zero, fixed cost is already there, $100, because in the previous example we also see that when you don't produce anything, you still need to pay for the rental of the land. Okay, so variable cost start from zero, but fixed cost start already is a positive number even though output is zero. Okay, so and then you can see that total cost is higher than variable cost because TC is the sum of FC plus VC. Okay, so this is what I mentioned just now in this example. Okay, in this example, when you calculate the marginal cost. Okay, so again, how you calculate marginal cost is the change in total cost. Okay, every changes you divide by the change in output. Okay, so you can see this application of marginal cost in this slide. So 170 divided by minus 100, you get 70. 70 divided by 1 minus 0, 1. So because the changes is every 1 unit, so that's why the MC is just the change in the total cost. Okay, so 170 minus 100 divided by 1 minus 0, you get 70. 220 minus 170, you divide by 2 minus 1, you get 50, and the rest. So here you can clearly see that MC decline first, then it goes up again. So this will be a more accurate representation of marginal cost function. Okay, so it declines, then it goes back, it goes up again. So this concept of decreasing and increasing again, okay, the part where it increases, okay, is what we call the the concept of diminishing marginal return. Okay, if you recall from the previous slide here, okay, we learned on the concept of diminishing marginal, diminishing. Okay, yeah, this one, diminishing marginal product. Okay, meaning that marginal product declines as you increase the amount of output. So the opposite of marginal product is marginal cost. Okay, because product is in terms of quantity. So when marginal product declines, so the opposite will be marginal increase. Marginal cost will increase. Okay, so if you plot both in the same curve, or you can see, or you can see the usually in some books you can see they plot this thing in a separate. So let me see this one. If the in this Arnold textbook. Okay. Um, um, okay. Never mind. Okay, never mind. Not important. Okay, but what you need to understand is that when it comes to product, okay, when you calculate marginal product, okay, you also see that marginal product can actually decline. Okay, meaning that it start to in this example just now. Okay, your MPL declines. Okay, it start from 1,000, then it start to decline. So whenever marginal product declines, okay, and then if you calculate the MP marginal cost, okay, marginal cost will start to increase, meaning that the movement will be opposite. When MPL decline, marginal cost will increase, because that is just the opposite. When the firm has or get less and less output when they hire more and more labor, okay, so that will lead to higher marginal cost. So MPL or marginal product will be the opposite of marginal cost. If you experience declining marginal product, the firm will experience increasing marginal cost. Okay, so that is what I want to mention just now. Of course, you don't see this one in the graph. Okay, but what is important is this concept of first, this concept of diminishing marginal cost. So the diminishing marginal cost is just this part alone. Okay, so this part is what we call diminishing. Okay, you can type on your own in the slide. Okay, diminishing. Okay, so I don't have enough. Okay, diminishing marginal cost, meaning it start to diminish or decreasing. So it start to decreasing first, and then it goes up again. So this part is the increasing marginal cost. Okay, the diminishing or the decreasing marginal cost is only this portion. Okay, once it reaches the minimum, then it will go up again. So going up is not diminishing, it's increasing marginal cost. Okay, so these are certain concepts that you need to understand. Okay, so the rest of the slide just focus on the plot of average fixed cost. Okay, you can see the average fixed cost continue to decline. Okay, why? Because fixed cost is, the amount is fixed. Okay, so when you divide by increasing number of output, of course mathematically average fixed cost will keep on getting smaller and smaller. So when you plot average fixed cost line, okay, so first, how do you calculate average? Average is total divided by quantity. Okay, so for average fixed cost, the curve will keep on declining. Okay, but for variable cost, average variable cost divided by quantity, you can see that the shape is almost like a U shape. Okay, U shape means it starts to decline, and then it reaches a minimum point, then it goes up again. Okay, so this is also very common or logical explanation, because variable cost, usually when you hire the first few labor, okay, average cost start to decline. Okay, but when you increase more and more labor, okay, the cost of your wages actually increases higher than the increase in the output. Okay, so for average variable cost, the shape, the typical shape will be like a U-shaped curve. It start to decline and then goes up again. Okay, so that is from the, and then if you plot the average total cost or average cost, okay, you can use the word ATC, okay, average total cost, or in some books you can also use the word AC, average cost. Both are referring to the same thing, average cost or average total cost. Okay, so average total cost is the product of total cost divided by quantity. So TC divided by quantity, you get average cost. So usually the shape is also like a U shape. It starts to decline, okay, and then it reaches a minimum point, then it goes up again. Okay, similar to variable cost. It declines first, and then it goes up again. Okay, but the main difference is the average fixed cost. Okay, because the cost remain the same, but you divide by the higher number of quantity. So for average fixed cost, so for average okay, there is the slide for, yeah, this one. Okay, so this is the slide for average fixed cost. So this is slightly different than average cost or average variable cost. Both average variable cost and average cost, the shape is like a U shape. But for average fixed cost, it is continue to decline, almost like a downward sloping curve. Okay, so when you plot all of these three curves together, okay, you get something like this. Marginal cost start to decline and then goes up again. Average cost And then average variable cost, both are like a U shape, okay, compared to average fixed cost keep on declining. Okay, so one thing that you need to observe here is the intersection point here. Okay, if you see on the, so you can see that marginal cost, oh sorry, I made a mistake. The main intersection point is this one, just the 2 point on the average cost curve, okay, on the AC, and also here on the average variable cost, okay, ABC. Okay, this point here. So marginal, so this is marginal cost curve. Okay, marginal cost curve, it will always cut or intersect average cost and average variable cost at the minimum point. So the point where MC cuts AC, this point, and MC cuts ABC, this point, these 2 points is the minimum point for each of the curve. So this point is the minimum point of average cost. This point will be the minimum point of average variable cost. So MC, by definition, will only cut AC at its minimum, and MC will only cut ABC at its minimum point. Okay, but for average fixed cost, not tak semestinya, not necessarily you need to cut at minimum, because average fixed cost there is no minimum point because the curve keeps on declining. So the point that I want you to focus is just between average cost and also average variable cost, AC and also ABC. Okay, MC will cut these two curves at its minimum point. Okay, so this is so for this slide, it's just for you to fill in the blank. Okay, for you to do your own practice exercise. Okay, you can calculate or fill up the blanks here so that you know how to calculate each of the component here. Okay, certain part is logical. Okay, because you know that it only gives you variable cost and total cost. Okay, it does not give you fixed cost, but you know that total cost is 50. Okay, and you know that TC is VC plus FC. Okay, so you can create another column for your average, for your fixed cost, and then you can solve the rest of this one lah, which is what you get here. Okay, of course, the best thing is not to look at this answer, okay, and practice this on your own before you refer to the answers here. Okay, so the rest of the slide just focus on the application of the why ATC is usually U-shaped, okay, why it declines and then goes up again, okay. And then also the point just now where I mentioned marginal cost, sorry, this one, okay, the hubungan or the relationship between marginal cost and also average cost, okay. So marginal cost will only cut average cost at its minimum point, okay. So this is the observation that you need to understand, or the summary of the relationship between average cost, average variable cost, and also average fixed cost. Usually when you plot the graph, we don't plot in terms of total, we plot in terms of average. Okay, that's why you can see that these graphs are all in terms of average, okay? Except marginal cost lah. So when you plot marginal cost, okay, you plot the rest of the cost in terms of average, okay, average cost and also average variable cost, okay, and also average fixed cost. You don't plot the graph in terms of total. Okay? You don't plot in terms of total cost, total because it makes it doesn't really give much information on the relationship between the cost. Okay, but if you want to understand the relationship between the cost, you need to understand, or you need to plot in terms of average value, average cost, average variable cost, and also marginal cost. Okay, so here you can just see the simple summary. When MC is less than ATC, okay, so when does MC less than ATC? It is less when okay, so this is your marginal cost curve, this is average cost curve, okay. So the first point is MC is less than ATC. So where does in the curve from this diagram MC is less than ATC? So the portion where this curve is below the AC, so this part here is where MC is less than ATC. So this is this one. Okay. Why? Because this part of the curve is below the average cost curve. So MC less than AC is this part. So you can see that AC is falling or declining, which is correct because at this point, you can see that average cost is declining, okay, which is true. But when MC is above AC, so when does MC is above? This part of the curve, okay? So this part is where MC is above AC. Okay? When MC is above AC, so this part of the marginal cost curve, so the relationship is AC is rising, which is correct because when MC is here, you can see that average cost start to increase. Okay, because this point is the minimum point. Okay, MC curve cross AC curve at when AC is minimum. So this is the point I've been making previously. Okay, so marginal cost will cut average cost at the minimum point. So this is the point here, okay, that we are referring to, the minimum point. So number one, when MC is below AC, AC is declining. When MC is above AC, this part, okay, AC is increasing. When the two curve intersect, AC is minimum. Okay, so that is the point number one, point number two, and point number three that you need to take back. Okay, that you need to understand for this chapter. Okay, so I think that's it for our discussion for today. Okay, next Thursday, I will discuss maybe a bit more on chapter number 6, and we will do some exercise from the past year. Okay, and then perhaps next Thursday, our class may not be too long. Okay, so if the chapter can be finished earlier, then we can spend less time on the material and maybe do more on the exercise. Okay, so I think that's it for